Well, next on the list, Steve, is Solaredge, and they just had their Q4 and full year, and revenue for them came in at 196.2 million. That's versus 189.2 million expected, Steve. So that was a nice beat. But unfortunately for Solaredge, that is about where the good news ended. Revenue for them, just so you know, that revenue report was down 38% year on year. So if you were looking at a company thinking, well, the worst case scenario is its revenue will stay roughly flat, SolarEdge has got a little story for you coming up. Earnings, Steve. They wanted to. Analysts wanted a $1.66. SolarEdge said, "We'll do 3.52." And things didn't look any less miserable on the year too, Steve. Full year revenue came in at 901.5 million, down just 70% from their 2023 filings. Full year earnings, Steve, they went from a respectable 61 cent per share down to just a negative $31.64 loss. We played up or down, Steve, and you did guess correctly at the time. But yes, of course, Solaredge was up on these results, Steve. He was up 25% on the day. And I'm going to say that I think the guide is probably the only reason why that is. They said they're going to do about 205 million in revenue, where they couldn't even adjust their operating margin guide to be profitable. That was still pointing at further losses. They did forecast positive free cash flow through 2025, though, which is quite positively received by analysts such as Oppenheimer and Truist. Other analysts also adjusted their target. Steve, JP Morgan, they said that they're going to raise their price target to $24. They said this reflects confidence in the company's improved cash flow and its potential to enhance investor sentiment. Citibank said absolutely not. $9, get it sold, highlighting concerns over the company's inventory levels and financial restatements. Oppenheimer, on the other hand, they were somewhere in the middle. They said it's got a perform rating, noting in their report that the challenges Solaredge faces in recovering profit margins and clearing inventories in Europe. But despite these challenges, Solaredge was pretty optimistic about its future in the call and had some plans to launch some new products and focus on just generally on operational efficiency. The bull case for Solaredge, Steve, is in their investor presentation, but to save people the hassle of having to read it, it's essentially global demographic changes. I think that as a populace, we're going to go from using about 60 exajoules of energy to around 160 exajoules of energy over the next 25 years. I think PV panels will make up a large chunk of that, around 50% if you read their report. But the increase is driven predominantly by essentially 33% more people on Earth, more urbanization, so you're going to be moving into more towns and cities, more EVs, more heat pumps, that kind of stuff. And if that happens, Steve, and Solaredge can weather this storm, I imagine you're going to be pretty happy with a Solaredge investment if you made it today. Stock price of about $18, way off that $370 highs. Makes it about $1 billion in market cap. Are you buying it, Steve?
That's a good question. So when we mentioned this earlier, sort of in the middle of the day, and you sent me your list of stuff that you were going to talk about, you mentioned this was a smallish cap now, and I probably wouldn't classify this as a mid cap anymore. I would classify a mid cap as between 2 and 10. I was a combination of. I was initially shocked that it had a 1 billion market cap, because in my head, if you'd asked me to take a guess at it, I would have gone much higher than that. And I wasn't sure whether that was the product of me remembering it or just kind of intuitively thinking it was probably higher than this, because we've talked about it quite a bit. It could be either, basically. They've lost a lot of ground, as you say, from their highs. But to pick up where you left off, if SolarEdge can weather this storm, I think they can weather this storm. I realise they have high inventory levels, but their balance sheet looks very strong to me. I have a general rule about, it shows up a lot in the case of Tesla, but this is something that just appears on X to me quite a bit, that when people begin by telling you about how strong a company's balance sheet is, that's not a great sign for that's where their bull case starts. And I don't mean it to be a great case sign about SolarEdge either. What I am telling you, though, is that I think it has the assets on hand to realistically see itself through. And if it can stay seeing itself through and positive cash flowing for the time being, I think things will get better. I think this is currently the worst it gets for things like Enphase, like SolarEdge, solar power equipment companies. So I think things will improve. From here, yeah, question of when, and being early could be equivalent to being wrong on this. If you have to sit around for 4 or 5 years waiting for revenues to come back here, well, you might wonder whether you have a better use for that cash over 4 or 5 years. And they've got to come back a lot to be worth it in that situation. Because if the S&P does 12% on average for 5 years, and you do too, with Solaredge, can be a very long way behind and need to find your way back. But all that being said, I'm more on JP Morgan's side than I am on Citi's. I'm sensitive to high inventory things. These can take a while to wear down, especially in this space without incentives to help shift the kind of backlog here, which I'm not convinced the US is going to go in for anytime soon. But I think if you can wait this one out, 1 year price targets, I don't have anything particularly bullish to offer you on this, but over a longer term time periods, as you said, Solaredge is sort of thinking 25 years or so in their investment case, and that's, I think there's a reasonable chance that they do okay over that amount of time. But yeah, I wouldn't buy this unless you're prepared to see it hit City's number, to be honest, which is 9.
Yeah, you have to be a bit of a thumb sucker, I think, Steve, with this one. I think you have to buy it and be prepared to sit on it, maybe indefinitely to earn a return. Just on your point, Steve, if it's America, you're worried about Solaredge isn't as exposed to America as everywhere else. It's more of a European style supplier of solar energy. So if you're worried about America, it'd be Enphase that you would probably skip, and Solaredge that you would buy if you must have a company in this sector. There obviously is a lot more competition in Europe with Siemens and what have you. There's a big inventory issue in Europe at the moment, which is where the vast majority of Solaredge's issues have been. I think it's one of those companies, Steve, where you've got to almost like take a pair of scissors to the company's history and just remove that bit from the past and treat it as a brand new company today. You're probably not going to get to those old highs of doing $3 billion of revenue in a year, not for a long while anyway. You've got to treat this as a company that's going to do a couple of $100 million a quarter, and it's whether you can stomach that valuation. Don't look at this as something like, well, it used to be there, so it might go back. That's not the right way to treat it. You take that chart and you take a pair of scissors back to today, and you evaluate it as what it is today, and forget about everything else. I think that's the way to look at it.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.